All right, great. Myths busted. Again, I am Ryan Detrick of Schaeffer's Investment Research. Very quickly about myself and the firm. I've been at Schaeffer's for 9 years now. I am the senior technical strategist. I do a lot of trading in our services. I see everyone saying I'm talking low. Not sure I get that louder. I'll just try and talk louder, I guess. Sorry about that. At Schaeffer's has been around for nearly 30 years. We're one of the world's largest options newsletters. Bernie Schaeffer started the company. We've grown to about 75 people. I think we're in over 150 countries. And again, what we focus on is options trading and looking at the world based on sentiment and expectations. So let's get right to it. What are the top myths that I want to talk about today that people are using in their trading that I think potentially are hurting them? First one, fundamentals are all that matter. Second one, the stock market is rigged. Next, a low VIX is bearish. Mistakes are bad. And lastly, I can't trust anyone anymore. Now, the first one I'm going to probably talk the most about, it's kind of our methodology here at Schaeffer's, and the last four, I guess, will be a little quicker. So this myth number one, fundamentals are all that matter. I've heard that a lot this year, and if you look at it, here are some examples that maybe that's not the case. The German DAX currently is up 30%, approximately 30% year to date, and very close to breaking out to new 5-year highs. Now, if you just looked at the fundamentals, the fundamental picture in Germany isn't very great. At the same time, Germany's GDP this year is expected to grow less than 1%. So if all you had to base your trading on is less than 1% GDP, you'd have no clue their market's up 30% for the year. And again, why is that up 30% for the year? I'm going to get into that here, but it's all about sentiment. It's all about expectations. They were simply too low 12 months ago. Now you have some good gains. Also, fourth quarter earnings, we talk about here in the U.S., fourth quarter earnings at the start of the year were expected to be up 18%. They lowered to 10 or 11% over the summer. Currently, fourth quarter earnings are expected to be up just 4%. So it was 18%. Now it's 4%. Nonetheless, we have an S&P that's up right around 15% year to date. So again, you've got lowering earnings estimates in the fourth quarter at least, yet an S&P that continues to go higher. And again, how can that be? Well, our theory is it's all about the sentiment and expectations are way too low. Expectational analysis is all that we are at Schaeffer's. It's what we've been working on. Bernie Schaeffer's been working on for 30 years. And it's a combination of fundamentals, technicals, and sentiment. And again, we think sentiment's kind of that last piece to the leg, I guess, that you need for consistent, longer-term positive trading. Something I like to talk about in all my presentations is the wisdom of the Great Sanhedrin. This, in the time of ancient Jerusalem, this is a council, I guess kind of their Supreme Court, of 72 judges and clerks. And what they did was they'd vote every day except for the holy days on whatever was important in the land at that time. And interestingly, what the Great Sanhedrin did is if all 72 voted for an item, they immediately threw it out. Now think about that. That's all about crowds and following the crowd. And, if everyone thinks one way, it can't be right. And I think it's fascinating. 2,000 years ago, they thought like this. And it's exactly kind of the basis for our methodology here at Schaeffer's today. Joseph Granville, a famous trader, says the obvious is obviously wrong. I think that's a really great quote. Now I'm going to talk a little bit about herd mentality. And hopefully you can zoom in here and check this out. This is a funny cartoon. Talks about I've got a stock here that could really excel, sell. And the bottom one, they're all talking about selling. Someone says goodbye. Sure enough, the crowd all of a sudden says, here's goodbye, buy, buy, buy. That's kind of how crowds work. Let's talk briefly here about herd mentality. Historically, Look back, at animals here. Zebras are a good example. Zebras tend to follow in herds and stay together. And why do they do that? Well, it feels better. You're safer. You look at zebras when they're all together. If one of them were to see a lion and turn away and run, all the rest of them, if they saw one running, they'd follow him. They would also run. They don't need to see the lion. Again, it's the best way for them to survive is when they stay together. Now, interestingly about zebras, and I just read this week, zebras actually do not get ulcers. And the reasoning, again, is about the way their brain is wired. They don't really worry. Their life is good. I mean, yes, if a lion catches them, that's bad, and they're going to die pretty quickly. But for the most part, they have a good life. And again, they don't get ulcers. It's been reported, no zebras ever have an ulcer because they just don't worry. And I'm not saying people shouldn't worry. That's a major difference between people and a trader. Clearly, the more you worry, we've all been there. We worry, we're going to have very poor results. So, my take is, well, let's all try and be more like zebras. Water buffaloes. I mean, check this out. There's a lot of them here in a herd. Again, if you're an animal, you're not going to mess with that. You're not going to go in and try and eat one of those guys or try and start a fight because you're outnumbered. And again, there's a lot of comfort in that. When you have a lot of people all thinking the same way, well, there's a lot of comfort to it. But again, what I'm saying is that's a myth that isn't always right. If you follow the crowd, you very well will not be rewarded. Now, historically, people make bad decisions when they're in a crowd and they all follow together. Here's an example of NHL up in Vancouver. They lost the Stanley Cup, and they had some major riots. Again, people together here when UK beat Louisville in the Final Four last year. They again had riots. Now, one or two people by themselves will not obviously do something as stupid as jump on a cop car. But when you're in a crowd, you think a certain way, and unfortunately that can happen. Getting up early on Black Friday to go buy something, getting in line to go buy a cell phone when everyone has cell phones. Again, you don't need to do these things, yet we continue to do it. A quote that we really like here is Humphrey B. Neal. The crowd is most enthusiastic and optimistic when it should be cautious and prudent, and is most fearful when it should be bold. Now, again, it all hammers down to buying. You want to buy. People say, buy when prices are low. Well, the way we look at it is maybe you want to buy when expectations are low. And the best way we measure expectations are through the use of sentiment. There's various ways, and I've given presentations, on this for an hour long. So trying to, hammer it home here pretty quickly. But, anecdotal sentiment, what's that? What's in the media? What's in blogs? What's on Twitter, your family and friends, magazines? What are the crowds telling you? Get together around the table at Christmas and say, hey, I'm really bullish the stock market here. Just get some of the reaction. I'm assuming most people probably won't agree with you too much there. Surveys and forecasts. There's all types of polls and sentiment polls out there. You can get a good feel. Sentiment polls recently, just 2 weeks ago, were flashing extreme levels of bearishness, and we kind of took that maybe that's a sign the market's about to bottom. With any good news, sure enough, we've had a pretty decent rally all of a sudden. Then quantitative, this is what we really break down at Schaeffer's, option activity, open interest, put to call ratios, analysts ratings, you can read the rest there. So those are different ways we try and slice and dice sentiment. Now, talking about magazine covers, we all know magazine cover indicators. It's a good way to feel for what the crowd, again, is thinking. Here's one of the most famous of all time. Business Week came out in 1979, The Death of Equities. Now, it did come out, I believe, about 18 months almost before the actual bottom. Nonetheless, it talked about how equities weren't the place to be, and that's kind of the sentiment you want to see. Just think back to last June. June of this year, there were a lot of concerns out there. The end of the world was coming. We pulled back just 10%. We saw extreme levels of fear in the option market that we saw consistent with March 2009, if it was a 10% correction. To us, that said, hey, things are a little extreme here, and sure enough, June was a really good buying opportunity. And we think we just saw another good buying opportunity a couple of weeks ago as a lot of fear came up. So if everyone is thinking alike, then somebody isn't thinking, a famous quote by General Patton. So let's hammer that home again. Here's the Wall Street Journal. And again, this is how you can kind of use media for trading edges. The exact same day as the market bottomed in 2009, there was an article talking about Dow 5000. Now, interestingly, the Dow, it wasn't even beneath 6,000 at the time. It was beneath 7,000, but it was a good extreme amount of fear. And if you remember back to that time, sure, there are a lot of reasons to be fearful. We think that's displaced. Fast forward to within hours of a major peak in 2007. Exercising ghosts of past despite the housing slump. Crashes such as 87 are likely to stay memories. Well, sure enough, you get that much confidence and feel that good about the stock market. It's funny how everyone agrees with you. That's, again, within hours of the peak in 07, right before the financial crisis didn't quite start yet. But again, that was the peak, and then we obviously dropped significantly after that. You just look at movies. The movie Too Big to Fail. I mean, what are we talking about? We're talking about the economic crisis. That's what's popular. People still want to talk about these things. Nonetheless, we have an S&P that's up over 100%, since the 2009 lows, and people still talk about this stuff. The recent Brad Pitt movie that just came out, I forget what it's called, but I guess he's a hitman. And when is it placed? It's during the financial crisis. So he's out taking out people during the financial crisis. Again, it's a movie based on, financial crisis. Oh, what a difference 23 years make. The first Wall Street came out in 1987, and it came out right before, I believe in August of 87. And sure enough, right before that, the stock market crashed. We all know the 87 crash. And what happened in that first Wall Street was there was this Masters of the Universe feel. Everyone wanted to become a broker after seeing that movie. Gave this, very powerful impression of Wall Street. And the market, had a crash very soon after. 23 years later, the second Wall Street came out. Well, the difference there, just a minor difference, they portrayed Wall Street as dirty. The reason of the crisis, all the hedge fund guys, you can't trust them. That came out in 2010. Now we all know since 2010, this market continues to do rather well. Sentiment surveys, the AAII poll, the NAAIM poll, which is active managers, what they're doing, Investors Intelligence, and the Bloomberg, Alex Strategist, some surveys we follow. Here's a neat one we've talked all over on our website, the AAII Bears. The 10-week moving average recently popped up around 40%, which, as you can see, the last few years, that's an extreme amount of fear. And again, when expectations are that low, when the crowd is that fearful, maybe you want to take once you see some positive price action, take a step forward, and that can be a bottom. And again, that's what we think we just potentially had. Wall Street strategists, incredibly, even with the strong stock market rally we've seen, are still down, just over 40% allocated to stocks. In other words, the other 60% to bonds and cash. We find that, the retail crowd has missed this rally. We know that. At the same time, a lot of the work we do with options and option sentiment, the quote-unquote smart money's missed the rally also. And that can be very bullish with it. Think like a sentimentician. Don't always follow the herd. I mean, that's what I've been hammering home here on this myth number one. Following the herd is not the way to make money if you're long-term, well, not a long-term trader, but on a longer-term basis of trading. You want to look for stocks that have low expectations. You want to, low expectations translate into buying power. We still look at the market here and all the outflows we've seen, various other things we follow. We think, yes, we've had obviously a great rally. We're up, significantly. We still think, from that contrarian point of view, there's a lot in the tank for this market overall can continue to trend higher. Lastly, success comes from buying low expectations, not low prices. Again, everyone says, during a financial crisis, well, banks are low, let's buy banks. They said that the entire way down. We saw a lot of call buying the entire way down, catching that falling knife. Eventually, the XLF was down 89%. There weren't too many people saying buy it then, but that's when the expectations were low, and that's when you want to buy. So that's myth number one. Again, like I said, that's a good chunk of what I wanted to talk about. Now, these other myths are things that I've heard this year that aren't true. The stock market is rigged, the popular one with the retail crowds. The hedge funds have all the info, all the advantages. What's interesting, though, is you can beat them at their own game if you use sentiment. Now, it turns out the market is rigged, actually, to a degree. In September, this might be tough to read, but you can go find it. In September, the NYSE was charged with giving information to some of the big hedge funds and institutions first in terms of when trades would go out. So they were hit with a fine, and again, my argument there though is that's for the real short-term trading, the high-frequency traders. That's not what I'm trying to do. I'm more of a swing trader. Schaeffer's are more swing traders. We'll hold things for a day or two, potentially up to a month or two. So the short-term trading I'm not too concerned with. But again, you could argue it definitely was rigged, and that's what the SEC charged the NYSE with back in September. But how can you get an edge, beating the hedge funds, institutions that are out there? Well, Schaeffer's, we've talked a lot about short interest. And we look at total short interest here. You can see it's that red arrow, or I'm sorry, the red line. And to keep this simple, when short interest on all optional equities, about 2,600 equities, are trending higher, it's usually a bearish time for the stock market. But check it out, when that red line starts going lower, that's usually the time you want to be bullish. In other words, those shorts are covering their bets. We think that's a sign institutions, hedge funds are covering their shorts, but actually putting money to work in the stock market. And what we like about it currently here, you can see I did this chart recently before the S&P started to bounce, but that red line has a long way to go lower. It's not oversold yet. So to us, we've had a good rally. There's a lot of shorts that are still out there that could be caught as this market goes higher and can provide a good buying opportunity for the market still. Here's a proprietary indicator we use. It's a combination of buy to open option data from the SP on the SPY, the QQQ, and the IWM. Again, to keep this simple, it's a put to call ratio, 20-day put to call ratio. It's extremely low. Now, what does that mean to someone listening here today, and what do we think it means to Schaeffer's? Well, again, we think, if you follow this option activity, that tells you what the hedge funds are doing. When this ratio goes higher, it's a lot of times showing that, there's more puts coming in than calls. When they're buying puts, yeah, puts are bearish bets, but that's also a sign that they're hedging themselves, and we think it means they're putting money to work. So this shows us, the hedge funds institutional world, are extremely drastically underexposed to the market here. And if this market can continue to go higher, this tells us that it's cliche to say, but honestly, when I see charts like this with all what we think, it really is the truth. There's so much money on the sidelines, and so many people have missed this rally, bet against it. That can be extremely powerful. Myth number 3, a low VIX is bearish. How many times have we heard that this year? When everyone is hedged, what does that mean? Well, if you look at the VIX option activity recently, we've been saying this is Schaeffer for the last 6, 7. There continually is record VIX call open interest. In other words, everyone is hedged. Everyone expects higher volatility. Now, if everyone's hedged, could you have a crash? Could the VIX go higher? Of course, we're not naive to that. But again, look at herd mentality. If everyone says something, it might not happen. And, interestingly, look at the VIX. Everyone says beneath 20, down around 15 is bearish. And it has been bearish, I'm aware, at 15 recently. But interestingly, the VIX existed before the financial crisis. So many people, I think, kind of forget that. Look at the long-term VIX here. Twice, last 2 decades, multiple years beneath 20. And not once did we have a crash during those months, or those years, I'm sorry. And we think, there's potentially another one of those. We've been beneath 20 really all year. We think we could be entering another one of those phases. We have multi-years low VIX. A low VIX doesn't mean, again, it's bearish. It just means there's going to be less volatility. And on the flip side, that can actually be rather bullish. So, don't follow the herd thinking or what they think on the VIX. Now, look at these instruments. The VXX, we all know that. That's the ETN on the VIX. Down, I think, like 90% for the year. So much money has been put into that. Again, that's Bernie Schaeffer wrote on our website recently, Schaeffer's Research, at schaeffersresearch.com. Mentioned this is one of the biggest disasters this year. Everybody would say Facebook IPO, the high frequency trading blow-ups. We think the huge bet on volatility totally blowing up in people's face is the biggest mistake this year. And look at the VXX. Well, that's a good example of it right there. Myth number 4. Mistakes are bad. I mean, we're all going to make mistakes. We know that. But people this year that are frustrated with the market, yes, we're up, but there's been, a couple different 10% corrections. So many people have been burned repeatedly. Everyone got in on the Facebook, not everyone. A lot of people got in on the Facebook IPO, got all excited about stocks again. Sure enough, they were burned. But the reality is, as a trader, we're going to make mistakes. I like to say I've done this, I've worked with Schaeffer for over 9 years, been trading for about 12 years. And I like to think I've made them all, but unfortunately, every quarter or so, I realize there's more mistakes out there that I keep making. But, that's part of the game. And mistakes are not bad. In fact, I think mistakes are good because you can learn from them. Here's a fun little thing you can do that kind of shows our brains are pre-programmed. And who knows, maybe we're pre-programmed to make mistakes. With your right foot, if you want to do this at the desk here, with your right foot, in a circular motion or a clockwise motion with your toes, make a clock, go clockwise with your toes, and then with your big toe on your right foot, and then with your right, put your right pointer finger out, make the number 6. If you did that, in all likelihood, your right foot spun around and went the other way, even though you're going clockwise. It cuts back. Now, I've heard some drummers that can actually do this because the way the brain works, I guess, with their hands and feet coordination. But most people can't do that. And again, to me, it hammers home our brains are intertwined a certain way, and who knows, maybe we are programmed to make mistakes, and we have to accept that. And it's just the way it goes. You can learn from it. Now, here's a neat example I heard about recently. How can rubber ducks help your trading? Well, back in 1992, there was a shipment of about 27,000 rubber duckies and other rubber animals for bathtubs and toys that were shipped from Hong Kong, making their way to Tacoma, Washington. About halfway through, over by Hawaii in January '92, there was an accident. I believe the boat hit something. The people were fine, but the boat or the ship it was on hit something, and it cracked. And sure enough, 27,000 rubber duckies were at sea, lost at sea. Now these are called friendly floaties. There have actually been books written about them, people talking about them. And what happened though, you call it I don't call it a disaster, but definitely a mistake without question. But what happened was over the course of the next, almost, I guess, till 2007, you can see on the right there, next 15 years, these rubber duckies floated all around the world, all around the globe. And scientists actually learned more about the way currents worked from this mistake or this disaster than they have in the history of the world. So again, this was a mistake, but they learned, which way currents work. And you can see up top, the red line up top, that went across the Arctic there, and they were stuck for years and years. Eventually, they learned about glaciers melting and different things. And it's kind of fascinating. But again, you can learn from mistakes if you have the right attitude, is my take. I've missed more than 9,000 shots in my career. I've lost almost 300 games. 26 times I've been trusted to take the game-winning shot and missed. I failed over and over and over in my life, and that is why I succeed. It's a quote by, of course, Michael Jordan. So where should we be investing now? Real quickly, where do we like at Schaeffer's? Well, we still like housing. Housing was one of our favorite sectors last year. We still think there's some price appreciation. There's a lot of negativity out there. Consumer plays, like retail and restaurants. A lot of people betting against consumer. We still think that's the place to be. We would avoid steel and coal. There's, again, very poor price action in those names, but a lot of bottom picking, a lot of calls coming in. We would avoid those also. And then bonds. There have been massive amounts of money put into bonds the last 6 years, 5 to 6 years, versus what's going to stocks. Nothing wrong with some bond exposure. Just be careful how much you put in there, because again, if there's such thing as a crowded trade, all the money going into bonds here with historic low interest rates, we think that could be a very, very crowded trade. And those are the ones you don't want to outright avoid, but definitely be on your toes should interest rates start trickling higher and bonds really take a hit. Lastly, I've got 2.5 minutes, and myth number 5 is I can't trust anyone anymore. Again, people are fed up with the stock market, even though we're not too far away from all-time highs. They feel like they can't trust anyone, and our take on that is, well, there are people you can trust. Here at Schaeffer's, you can follow us on Twitter. You can follow me. You can see it on the screen there at Ryan Detrick. At Schaeffer's is our main Twitter handle. Some other traders, Todd Salamone, who some of you might have seen on TV and read before on our website, and then Joe Bell and Brian Sapp are the last two. You can follow them. They're always on there talking about what they're seeing out there in the world. And I'd like to think, we give honest opinions, and, you can see here, we have Schaeffer'sTradingFloor.com. It's a new website that we just rolled out a couple of months ago. You can see up there it says outspoken, contrarian, opinionated. We try to do that. We're not always right. I mean, nobody is right. I personally run the other way, but we're trying to be honest here. Outspoken and contrarian also, which is kind of our mottos. But again, this is a neat website. I like to say it's for traders by traders. Again, it's just for our traders on our floor, about 6 of us or so, that give our opinion what we're seeing. Kind of a free-for-all, just whatever we're seeing, we talk about it. And hopefully you can check that out every day. Lots of information on there, and you can follow me. I try to write on there maybe 3-4 times a week. See what I'm watching, along with following me on Twitter there. So I've got, I guess, 1 minute. Thank you very much for listening. I guess if anyone has this, I wasn't really following. Okay, there's somebody who says, how about gold? Type in a question or two if you want. I can try and answer these for the next minute. Our take on gold is, again, it looks like a pretty crowded trade. Doesn't mean you shouldn't be in gold. We kind of like silver a little bit more if I had to pick one that we like. But gold makes sense to have some in your portfolio, but it just hasn't really gone anywhere for a very long time. Now, you could argue technically that's good. If it's just basing, I can't disagree with that. But again, it looks like a pretty crowded trade from a lot of the things that we're seeing. I see someone said the second movie of Wall Street was crap. I would agree. Yeah, it wasn't very good. Looks like that's all I'm seeing here. If fear is high, how is the VIX below 20? That's a great point. Unfortunately, I got 10 seconds, so I can't answer it. But if you look at all the VIX calls that are out there, we would say there's still a lot of fear, although the VIX is low simply because there's not as much volatility. Hopefully, I answer that with the time. Thank you very much.